key takeaways. In general, there's optimism. People understand that rate cuts are coming. People are looking for these deals with a low cost basis. People understand that the higher interest rates pause transactions, and they're seeing these rate cuts as the light at the end of the tunnel. So you're certainly getting some of that feeling. You're seeing these distressed assets that are slowly emerging. Most people are able to figure out a way to restructure the debt to make it work, but some just can't. And we're going to see some of those opportunities. And people are expecting more transactions than last year. Last year was pretty quiet. This year, we're hoping that there's going to be a lot more and finally.
Welcome, everybody, to today's episode, where we're going to dive deep into the heart of the multifamily industry. Today, we are diving into the recent NMHC conference, which stands for the National Multifamily Housing Council, and they host a conference every single year. It's an event that brings together the brightest minds and the leading figures in the multifamily housing space. It's a melting pot of ideas, trends, and discussions shaping the future of our industry. And who better to guide us through these insights than Ravi, the COO of Viking, who has just returned from the conference, and he's brimming with knowledge and foresight. Today, we will discuss how these insights propel us toward the success in the multifamily market in this coming year and in the future. So welcome, Ravi.
Thanks, Nathan. As always, happy to join you in this episode.
And this is a fun one too. One of the largest and most vibrant multifamily conferences. So what was your kind of initial impression this year of the atmosphere, of the people, of the themes?
Yeah, this is the second year I've gone, and it was the overall feeling and atmosphere was a little bit more positive than it was last year. Last year, there was concern. There was still a lot of COVID concerns that were out there. There was concern about whether there would be much of any product in the market. And in fact, there really was not a whole lot at all last year. So I felt that it was overall not as positive of a message. But this year, people are looking at more transactions. They're looking at interest rates dropping, the gap that is closing between the seller and the buyer in terms of accepted pricing. So overall, it felt really positive, and I came away feeling energetic about our future prospects.
Yeah, I just read this report that polled a bunch of operators, sponsors, those are actually operating the multifamily assets, and they're saying that 60 to 70%, likewise, kind of echo what you said, had this kind of positive sentiment about this next year moving into 2025, which is great. Because 2023 was definitely kind of a tough year for multifamily, right? Coming out of the highs of 2021, 2022. 2023 was much more a year of stabilization, and now we're kind of seeing the horizon again, which is great. Can you talk us through some of the major topics or trends that were kind of a major focus of this year?
Absolutely. I think the biggest trend was technology. A lot of people were focusing on AI and how AI is going to help with asset management and operations, and that was a major theme. Asset management, operations, tidying up bad debt, making sure the apartment is running very streamlined is a huge focus, because as the values drop because cap rates go up and we're looking at exits in the next year or two, people really want to optimize all the expenses and increase the NOI as much as possible. So I saw a lot of that. Also, there's a lot of people interested in buying. That was an overarching theme. Everybody's looking at the best priced asset, something that really has a low cost basis. People aren't necessarily looking for cash flow. They're looking for a low cost basis play so they can potentially sell in 5 years in a better market and make their gains on exit rather than cash flowing. There's also themes on sustainability and green practices, more so than other years because of the greenhouse gas reduction fund that's going to open up this year. There was more talk about ESG and those types of initiatives. Those are the themes that stood out for me.
Yeah, that makes a lot of sense, right? Kind of a very similar theme, but I would call it almost like on steroids for what we saw in 2023, right? That kind of tech space and AI was just somewhat entering the multifamily space. Same thing with ESG initiatives, gaining more traction among investors. And now as we move into 2024, those that have that momentum are really kind of carrying forward to really hopefully propel themselves into 2024, specifically on the AI front too. I saw a lot of that just through talking with a bunch of investors and operators. They're really excited about what and that new tech can bring to the space and help bring a lot of optimization to the industry. Were there any key speakers or sessions that you found especially impactful?
Well, I actually didn't attend any of the lectures and the talks. And the reason being is because the majority of the conference is really for networking. I mean, that's the majority of the reason most people go. They go to meet people that want to sell, that want to buy, that have products they have to offer. But I can tell you there are a few people I met that really had a major impact on me. One of them was a woman that works for the Davis companies, and this is a company that also does multifamily syndication, does all the type of real estate, and then also allocates certain amount of equity in the pref equity space, or maybe just in general LP equity to other providers. Her name was, I guess I can say her name. I don't think she's holding it back. Her name is Rachel Edwards, but she was just very dynamic, very positive. I really liked her energy, and I felt like we could really work with her. So that was one person that left an impact on me. The other company that left an impact on me, and the person is somebody named Sunny from Canopy Analytics. It's an analytic program that will tie in multiple data points in property management software. It'll compile it in such a way that it creates actionable items. So you can really, on a daily basis, you can really determine what you need to do on each property to make change. And I really enjoyed that. And I'll add one more, Nathan. I just spoke with another group. It's a group called Pinewood Partners, and they have money interest. They have capital that they want to invest, but they want to invest with the right sponsor. And we were really jiving on some of the same interests, like ESG, like certain types of tax credits that we're looking for, certain ways that we treat our tenants, health and wellness. We really lined up exactly in terms of what we wanted in a partnership. So that was really exciting. So you're meeting people from all different walks of life, and sometimes it's like the random person you meet that provides a ton of value, and that's what tends to happen at these conferences.
Yeah, no, that makes a lot of sense. There's kind of three different people, or at least groups of people that I see kind of go into the NMHC conference. It's going to be operators, sponsors that are actively owning, managing, purchasing, selling these assets, specifically multifamily. You have brokers who are kind of more on the selling side of things, creating the offering memorandums, talking with operators, bringing those different offers to the seller. And then you have kind of vendors that are servicing the space specifically for multifamily. So whereas most conferences can be more kind of investor focused, where it's a lot of investors that want to get intel on the market and kind of trends that they're seeing, this conference seems to be more operator focused and much more kind of deal focused. Is that an accurate assessment?
Yeah, it's very much about brokers meeting with sellers, buyers and sellers. It's about people that have certain products that they want to sell to maximize operational efficiency, or increase organization of your investors, or whatever it may be. So those type of people. It's insurance people, it's debt brokers. It's like basically all people from all different aspects of multifamily investing all in one space. And you can have meeting after meeting after meeting, which does get tiring after days and days of doing it, but you get so much done in such a short period of time. It's absolutely worth going to.
And it shows the power of going to these conferences with an intention too, right? Like I know that when you and Judah, the director of acquisitions, and Ed, the director of asset management, all went this year, we made a kind of a very clear intention of who we were targeting, who we were going to speak with, the different kind of cadence of those meetings to really kind of squeeze as much juice out of the conference. And we advise the same for anybody who's going to any conference, is to figure out what is your kind of intention. Is it to meet everybody under the sun? Is it to find investors? Is it to find deals? Is it to attend the sessions? Because it's gonna your intention is gonna dictate how you operate in that conference. You want to make the most of it.
Absolutely.
How do you plan to take some of the trends and conversations that you've had and integrate them into Viking's already existing strategy or initiatives for 2024, and then potentially onwards as well?
Absolutely. It's a great question. So I think number one is acquisitions, right? So we're very interested in being opportunistic in this environment, because you have interest rates coming down. You still have a relatively low cost basis compared to the highs of 21, 22 on certain assets that are hitting the market. And we're looking at acquiring assets that have a low cost basis, that have some cash flow, and where we can see a very profitable exit. So that's number one. And you have an idea when you go into these conferences, but if it's corroborated by nearly everyone you meet, that what you're thinking is pretty close to what you really want to achieve, and what's achievable. So that's the number one takeaway, is really focusing on those assets with a low cost basis. The second one is tightening up our operations. And I mentioned to you Canopy Analytics, that one program. Now, I don't know if we're going to use them necessarily, because I like them, but it just made me think about all the other options out there. So now we are reviewing all of these various options in terms of asset management software so we can really gain some additional strength in that regard. So that's number two. Number three, I spoke with a couple people about some tax efficient strategies and really want to look at those options to decrease operational costs. And then four, I mentioned ESG. We're really putting together a nice, robust ESG program this year. And we're looking at implementing solar and other types of initiatives and complexes. And it will make financial sense as well. It's not just something that we're doing for the greater good. It's also the greater good plus makes a bunch of financial sense. So those are the four ways that I see that we're going to change some of the ideas we're going to implement moving forward.
And I think that the conference really speaks to the power of getting in front of people and meeting face to face too, right? We all know that real estate's a relationship business. And for a while with COVID and with lower deal flow, some groups chose to kind of sit back and not really go out there and meet brokers or tour properties unless it really made sense. And that's kind of what you were saying earlier, right? Where you're alluding to where there's a bunch of capital that was sitting on the side that's really kind of waiting to invest and is just waiting for kind of the right time, right? Once those interest rates do come down. From a deal flow perspective, it makes a whole lot of sense to talk with brokers at this conference, because we had a plethora of deals come out of just conversations that say, hey, here's an off-market deal. Here's a deal that's coming soon in a couple of weeks, but we want you guys to take a first look at it. Here's a bunch of deals that we're currently marketing. And it's a good kind of start to the year, because generally how deal flow goes is at the end of the year towards kind of the holiday seasons, deal flow kind of stops, it dries up. As you move towards the beginning of the year, there's not that much deal flow until this conference happens, because a lot of the brokers and a lot of the operators are kind of holding off on deals, and we'll kind of use this conference as a springboard almost to kind of propel the launch of their deal. Can you talk a little bit about what a low cost basis is for those who don't know, and why it might be a valuable strategy given kind of the times that we're in?
Yeah, absolutely. So, and first I'll talk a little bit about the broker interactions that I had, because I think this is another important detail. Some brokers had a decent amount of deals, but they were all distressed deals. Like ones where, like, for example, it was a student housing. I saw a student housing deal where they had a systemic issue with mold and many units were down, and they're like, oh, this is a great option with a low cost basis. And I'll talk about cost basis in a second. You just come in here, clean it up. Or there's another deal with a very low occupancy. You can't get standard agency debt. So I saw a lot of those types of deals out there because those brokers didn't have anything better to show people. So that was on one hand. On the other hand, there were brokers that had maybe fewer deals, but they were decent deals. But they're also saying that what happened was when the COVID highs came through, rents were rising like gangbusters in a very unsustainable way. People weren't renovating units, and the rents were still very high. And then the rents started dropping steadily. But these sellers are going in thinking that, hey, I can actually, the new buyer could come in, renovate units, and get even a higher rent than they were getting before. The sellers were looking at those products and thinking there's no way that's going to happen. So there's a bit of a disconnect. So I heard that multiple times, where there's a disconnect between buyer and seller. So that is, again, it's still there, but it's actually becoming smaller and smaller. So when it hits the point where those curves collide, that's when we're going to see a lot of transactions. And it's almost there. So those were some of the broker conversations. As far as cost basis, what that means. So cost basis is basically the price you are paying for the asset after all expenses included, like the base price. So like the price per unit you can think of, for example. So like, for example, in the peak of the market back in 2021, you could buy an apartment complex, like a 70s apartment complex in a really good area for $270,000 a unit. And it made sense because the property was cash flowing with the debt that was put on it. And the debt was highly leveraged. So like maybe like a 75, 80% leverage. And it was extremely low interest rate, 3%, 3.5%. When you are lending money at 3 and 3.5%, you're basically giving money away because it's on par with inflation. So you're literally just handing money over, saying, hey, buy this asset. And that's what was happening. That's why the prices were so incredibly high. And people were buying those assets. What's happening now is with the interest rates coming up, cap rates going up, people are like, these deals aren't cash flowing. It doesn't make any sense. Therefore, the overall cost basis goes down. The cost per unit goes down. And some of those 270 peaks, like as I mentioned before, 270,000 per unit in a 70s asset. Now you're seeing those same assets selling for like maybe high 100s. It's a huge difference. And that the cost basis there has dropped considerably, maybe 80,000. But say that asset isn't cash flowing because your interest rates are so high, leverage is low, you have to use LP equity, which is expensive. Maybe you aren't cash flowing right away, but that might be fine because the cost per unit is so low. You may not be cash flowing right away. Wait 3, 4 years when you start implementing your value add plan. When you're able to refinance, you're going to start cash flowing really well. And then when you sell, you're starting from a lower, very low basis, and you're going to sell into a high basis, and you're going to make your money there. So that's how you think about cost basis.
Yep. No, it makes a whole lot of sense, right? Like you might not have the cash flow right now, but relative to what other assets were bought and sold for in the past, you're buying at a discount, like almost going to Costco and where everybody else is paying $5 for paper towels, you're paying $2. So it's the
Yeah.
same thing at the end of the day, but you got it at a lower cost. So when you go to exit, if those assets trend similarly, you should make a pretty decent profit. Like that's the pitch that they're proposing.
Yeah.
Was there anything at the conference, perspectives, viewpoints, conversations that came as a surprise to you or something that you weren't expecting?
Yes, Nathan. So I knew that there were going to be distressed assets out there, but in my conversations with several sponsors, I didn't realize the extent of the distress that was out there. There are people that bought at the peaks that cannot refinance and that are going to just turn the keys over to the bank in essence. I was surprised with the number of people I spoke with who had major issues in that regard. I knew I was going to see some of it, but the amount of it was much higher than I thought.
Yeah, no, it makes a lot of sense. And we're seeing that even on the acquisitions front, where there have been brokers who've been bringing us deals and said, hey, this current seller bought the asset for 170 a door, and now, we're trying to sell it for 160 a door. So they're selling it less than their previous basis. And those are really the truly motivated sellers. And generally the brokers are pretty upfront to say, hey, this is a motivated seller, they need to sell. Or they'll say this is kind of like the bottom price that the seller is willing to accept. Because we've seen kind of both ends of the equation happen in this first month of 2024, where you have really motivated distressed sellers who need to sell their assets, or you have those that are, may not be as motivated and are just kind of seeing what the market would price their asset for. And that's kind of one of the key tactics for real estate is you want to find motivated sellers, right? But you still want to take a look at the deals, even if they aren't really motivated, because they might make sense at what you're looking for.
Yeah. The interesting thing about it also, Nathan, is that as much as I saw out there are very few foreclosed assets that are on the market as well. So people, even though they're running into trouble, they're still finding ways to piece them together and make them work.
Yep, absolutely. And this is, as you said, kind of the second year that you attended the conference. Outside of just the general sentiment, was there any kind of major differences that you noticed between last year's conference and this year's conference?
No, just what I mentioned before, just the energy level, the excitement was higher. But other than that, it's fairly straightforward. I felt like it was the same kind of feel, and it was really the same type of strategy and networking as much as possible.
Yeah, that makes sense too, right? Like if you have brokers and operators last year who couldn't really get deals done, either because there was that, what we call the bid-ask spread, the difference between what sellers are willing to sell their assets for and the difference between pricing on what buyers can afford to pay with interest rates and their return structure. And so it makes sense that because deals weren't getting done and brokers were admittedly pretty frustrated last year because lower deal flow, less things to do, less work to be done, and fewer offers that you're able to bring to the seller. I think that makes a lot of sense that moving into 2024, where there is hopefully a little bit more deal flow with the rate cuts that are planned to be done. I'm not going to have a crystal ball and say how many they're going to be, but the general consensus is anywhere between 3 to 5 rate cuts this year. And that should hopefully help with transaction volume, especially with all those other players that are kind of sitting on the sidelines and have a bunch of, what we call dry capital that they're ready to deploy. They're pretty much having to deploy in 2024 as soon as those rate cuts come. So it's going to be, what we're projecting is that the second half of 2024 is going to be pretty competitive because you're going to have a bunch of these groups. There's going to be more offers on deals, which is going to only elevate pricing and condense cap rates. So we'll see kind of what the latter half of the year holds. But I think this is a really great start to the first half of the year.
The other issue with that, though, Nathan, is when there's variability or uncertainty, there's less transactions. And even when you have rate cuts, what happens is sellers are looking at those rate cuts and they're like, wait a minute, hey, if I hold another maybe a month, then I'll get a higher price because the rates are coming down. People will get a less expensive loan. They'll be able to afford it. So we're also seeing some of that. So and in fact, there's a major apartment buyer. I think it was BlackRock or Blackstone, but they had an asset. They're right about to market it. They spoke with the broker, ready to go. Last second, they pulled out because the rate cut news came out. And they're like, well, hey, let's hold it. and let's wait because next year the rates are going to drop. I'll get a higher price. So that's another issue that we're trying to navigate. Some people may have to sell because their loan is coming due. Those are the sponsors we want to hit up. But those that can wait, usually in this transition period, they're usually waiting.
Yeah. I mean, which speaks to the power of cash flow too, right? If you're able to kind of weigh out the market, you're not forced to sell, and you can kind of time your exit with the market. That's an ideal scenario,
Yeah.
Which is great. All right, awesome. Ravi, any other kind of last takeaways, golden nuggets from this conference? Would you recommend it for everyone, or only kind of a select group that you think should go to these kinds of conferences?
Yeah, Nathan, as far as a conference goes, I wouldn't recommend this one for all comers. This conference would be for those that are really involved in the multifamily housing market. So for LP investors out there, this is not one to go to. But for those that are syndicators, yes, absolutely, I would recommend to go to. As far as key takeaways, in general, there's optimism. People understand that rate cuts are coming. People are looking for these deals with a low cost basis. People understand that the higher interest rates pause transactions, and they're seeing these rate cuts as the light at the end of the tunnel. So you're certainly getting some of that feeling. You're seeing these distressed assets that are slowly emerging. As we mentioned just a couple minutes ago, most people are able to figure out a way to restructure the debt to make it work, but some just can't. And we're going to see some of those opportunities. And people are expecting more transactions than last year. Last year was pretty quiet. This year, we're hoping that there's going to be a lot more. And finally, it's hard to find cash flowing deals right now, but cost basis plays are really big.
Yep.
So that's something to look forward to.
Yeah, 100%. One last kind of trend that I've been noticing that might have been discussed at the conference. I don't know if it was or not, but kind of the supply and demand dynamics in a lot of these markets. So to give you kind of the listeners a bit of backstory, during the pandemic, 2020 through 2022, you had a lot of pent up demand with housing affordability was at a low. And so there's a lot of people looking for housing and renters. And so what developers did was they end up building a ton of new construction, new apartments, and it takes about anywhere between 12 to 24 months, depending on kind of the size of the property, to really have those properties be delivered. And what we're seeing now is that in some of the major markets that saw a lot of the demand in the past 2 years, there's now a wave of new supply that is going to hit those markets. And so we're expecting decreasing rent growth, potentially higher vacancy, because renters have more optionality now with where they can choose to rent. And new construction always kind of caps the amount of rent growth that older vintage assets can have. So that's what we're expecting kind of for the next year or so. But again, it's short-term turbulence. The long-term fundamentals are still there for multifamily, but we're expecting to see not as high rent growth as we saw in the past few years, which is nothing to be surprised by. It's just a return to kind of normalization, back to equilibrium, but something that investors should be aware of and expecting as we move into the next few years here.
Yeah, I'm glad you brought that up, Nathan. There was a lot of conversation about newer assets being sold and newer assets being sold for a decent price because the markets have softened, as you mentioned. They aren't able to get that really high rent that they could several years ago. So that's another place to look for good deals is in newer assets.
Yep. Especially if we're talking about that low cost basis, right? If you can get a brand new at a discount, that's amazing, right?
Yeah.
Awesome. I appreciate the insights, Ravi. It's always great to have you. Glad to have you back. And I'll see you in the next episode.
Absolutely. Thanks, Nathan.
If you like this podcast, please hit subscribe or a thumbs up, and we'll see you next time.